At some point, someone probably told you one of two things. Either invest in property. It's real, it's safe, it always goes up. Or put your money in the stock market. Let compounding do the work. And both of those people sounded confident. Both of them had examples. Both of them had stories. So you're sitting there wondering, who's actually right? Which one builds real wealth? Which one is smarter for someone like you? And here's what nobody tells you up front. This isn't a competition. It never was. But before we get to that, let's actually look at the numbers honestly, because both sides of this debate stretch the truth a little, and you deserve the full picture. Hi, I'm Rishi, and today we're breaking down one of the most debated topics in personal finance, real estate versus stocks. Not to pick a winner, but to help you understand what each one actually does, and which one fits where you are right now. Let's get into it. The numbers first. Let's start with raw returns, because this is where most arguments begin. The S&P 500, which tracks the 500 biggest companies in the US, has delivered an average annual return of around 10 to 12% over the long term, including dividends reinvested. That's not a guess. That's decades of data. Now, real estate. U.S. single-family homes have appreciated at roughly 4 to 5% annually on average since the early 1990s. On the surface, stocks win. Easily. But here's where real estate investors always push back, and they have a point. That 4 to 5% is just price appreciation. It doesn't include rental income. It doesn't include leverage. And leverage is where real estate gets genuinely interesting. Here's a simple example. You put $50,000 down on a $250,000 property. The property goes up 5% in a year. That's $12,500 in value gained on a $50,000 investment. That's a 25% return on your actual money, not 5%, because you controlled $250,000 with only $50,000. You can't do that in the stock market with serious risk. So when people compare returns side by side, they're often not comparing the same thing. Stocks give you cleaner, higher percentage growth on paper. Real estate gives you leverage, rental income, and a physical asset. Both matter, but they work very differently.
What stocks actually give you? Think about what happens when you invest in an index fund. You're not buying one company. You're buying a tiny piece of hundreds of them. Apple, Google, Amazon, Microsoft, all of it in one move. And then you just wait. No tenants, no maintenance, no phone calls at midnight. According to historical data, $34,000 invested in the S&P 500 in the year 2000, with dividends reinvested, would have grown to around $225,000 by 2025. Through two major crashes, through a pandemic, through recessions, it still grew. And the other thing stocks give you that almost nothing else does is liquidity. If your life changes tomorrow, you can sell your stocks in minutes. That flexibility has real value, especially when you're younger. Especially when life is unpredictable. The downside is just as real though. Stocks are volatile. They can drop 30, 40, even 50% in a bad year, and it happens faster than you expect. One bad earnings report, one piece of global news, and your portfolio is down thousands in a single afternoon. You refresh the app, the number's worse. You refresh again, still worse. And that's when most people make the mistake. If you panic and sell, you lock in the loss. The biggest enemy of stock market returns isn't the market, it's the investor. Behavioral economists call this the fear and greed cycle, the pattern where people buy high because everyone's excited and sell low because everyone's scared. Most people don't earn the market's average return because they can't sit still. What real estate actually gives you. Now let's talk about what real estate does differently. When you own a rental property, you have a tenant paying down your mortgage every month. You're building equity with someone else's money. And if you've done it right, there's cash flow left over after expenses. That's a fundamentally different model than stocks. Real estate also does something psychological that stocks can't. It feels real. You can drive past it, touch it, show it to people. And when the market crashes, your property doesn't show you a scary red number every morning. The price is just less visible, which for a lot of people actually helps them hold on because they're not tempted to panic sell what they can't see falling. Real estate also comes with tax advantages that stocks don't. Depreciation.
mortgage interest deductions, the ability to defer capital gains through strategies like a 1031 exchange. Over time, these add up significantly. But here's the honest cost of real estate that people underestimate. It is work. Finding the right property, negotiating the deal, getting financing sorted, dealing with tenants, the ones who pay late, the ones who call about every small thing, the ones who leave and take the deposit dispute with them, maintenance, vacancies, property taxes, management fees if you hire someone. It's not passive in the way people imagine it, especially not in the beginning. And the entry cost is high. That down payment, the closing costs, the upfront capital. Not everyone has access to that, and not everyone has the time or temperament to manage it. The psychology behind which one you choose. Here's something worth pausing on. A lot of people don't choose between real estate and stocks based on numbers. They choose based on what feels safer to them. And that feeling is shaped by where they grew up, what their parents did, what they've seen work in their community. If you grew up watching your parents build wealth through property, property feels like the real answer. If you've been reading about compounding and index funds, stocks feel like the obvious choice. Neither instinct is wrong, but it's worth knowing that your gut feeling here is probably more about your history than your math. There's a concept in behavioral finance called familiarity bias, the tendency to favor investments you understand or that feel familiar over ones that might actually perform better for your situation. The best financial decisions cut through that bias. They ask not what feels comfortable, but what actually fits your goals, your timeline, and your life. So which one is actually better? Here's the honest answer. Over a 25-year period, the S&P 500 has generally outperformed residential real estate in raw returns, but real estate with leverage and rental income, it gets much closer. And in certain markets, certain periods, certain properties, real estate wins. The real question isn't which asset class is better, it's which one is better for you right now given your situation. If you're starting out with limited capital and you want simplicity, liquidity, and long-term compounding, a consistent investment in index funds might be the smarter starting point. If you have capital, patience, and you actually want to manage something, and you're in a market where the numbers make sense, real estate can build serious wealth. A Cornell University study found that having around 10 to 20% of your portfolio in real estate, alongside stocks, produces better risk-adjusted returns than either one alone. Not because one beats the other, because they balance each other. Stocks are liquid, volatile, hands-off. Real estate is illiquid, stable, and tangible. Together, they cover each other's weaknesses. The closing thought. The debate of real estate versus stocks is really a distraction, because the real question is never which one wins, it's which one you'll actually stick with, which one you understand well enough to stay in during hard times, which one fits the life you're actually living. Because a good investment you hold for 20 years always beats a great investment you panic sell out of in year 3. And here's something most people skip entirely. The best investors aren't the ones who found the perfect asset. They're the ones who found something they understood well enough to trust, and then trusted it long enough to let it grow. Whether it's a property or a portfolio, the strategy that builds wealth is always the same. Start early. Stay consistent. Understand what you own, and don't let fear or comparison pull you off course. If this helped you see things a little more clearly, don't forget to subscribe. I'll see you in the next one.